This year, we've believed in a very simple formula. When global M2 liquidity expands, Bitcoin goes up. It was the so-called everything code. But since mid-2025, M2 has clearly been increasing. So why has Bitcoin been moving sideways or even falling? That perfect code has been broken. If you are still trading by only looking at the M2 chart, you need to stop. Right now, you are holding on to a formula that is already broken. Today, we track the betrayal of M2 and follow the flow of the real money that is actually moving the market. Before we dive into the analysis, let's review what we used to believe. Macro investor Raoul Pal called Bitcoin a barometer for global liquidity. The theory was that governments, struggling with massive debt, have no choice but to print money. This floods the market with M2, or broad money, pushing people out of depreciating fiat currency and into scarce assets. Bitcoin, with its fixed supply of 21 million coins, was the perfect escape hatch. And in fact, the explosive M2 growth and the Bitcoin rally during the pandemic seemed to prove this theory. It was so perfect, so elegant. But then, in 2025, this perfect correlation started to crack. The M2 money supply was steadily increasing, but Bitcoin ignored the signal to follow its usual 12-week lag. Instead, it moved sideways, losing momentum. What's even stranger is that other risk assets like the Nasdaq continued their strong rally. This means it wasn't a problem with overall market liquidity. It was a factor that specifically targeted Bitcoin. What was this force powerful enough to defy the massive M2 trend and stop Bitcoin in its tracks? The culprit wasn't the Federal Reserve or the Fed. It was the US Treasury, and specifically an account called the TGA. TGA, or Treasury General Account, is the main checking account that the US government holds at the Federal Reserve. Simply put, it's the US government's wallet. The government fills this TGA account by collecting taxes or issuing bonds, and it spends money for fiscal spending from this account. This simple mechanism is what just rocked market liquidity. The key is that the TGA balance and market liquidity move in opposite directions. When the government issues bonds to fill up the TGA account, private banks and investors use their cash to buy those bonds. This cash is removed from the commercial banking system and moves into the TGA account at the Fed, where it gets locked up. In other words, the process of increasing the TGA balance acts like a vacuum cleaner, sucking liquidity out of the market. In mid-2025, the Treasury enacted a policy to rebuild its TGA balance by about $500 billion. This had the exact same impact on the market as the Fed's official quantitative tightening, or QT. It was a shadow tightening. Now, this is the most important part of today's video. If the TGA was draining liquidity, why were the Nasdaq and gold just fine, while only Bitcoin took a hit? This comparison chart says it all. While the TGA was sucking up liquidity, the tech-heavy Nasdaq and gold actually showed strength. This is a phenomenon you could never explain if you only looked at the M2 macro variable. Each of these assets had its own engine that allowed it to endure the TGA shock. Tech stocks, especially the giants in the Nasdaq 100, had two powerful defense shields. First, the massive, ongoing narrative of the AI revolution simply overpowered any short-term liquidity changes. Second, these companies were already sitting on massive piles of cash, so they didn't need to rely on outside financing. And what about gold? Gold is both a liquid asset and the ultimate safe haven asset that shines when market uncertainty rises. The tightening signal and uncertainty caused by the TGA rebuild actually highlighted gold's appeal as a safe haven, and steady buying from central banks supported its price. So why did Bitcoin break down? The answer is that Bitcoin is located at the far end of the risk curve. Bitcoin doesn't generate its own cash flow like a tech stock, nor does it have thousands of years of history as a safe haven or demand from central banks like gold. Bitcoin's price is intrinsically dependent on marginal liquidity, that is, the most speculative, risk-on capital newly entering the market. That $500 billion absorbed by the TGA might seem small compared to the entire M2 supply, but it was precisely the marginal capital that was most likely to flow into Bitcoin. Tech stocks had earnings, gold had its safe haven status. But Bitcoin's single lifeline, liquidity, got thinner, and it took the full force of the blow. To understand this phenomenon more deeply, you need to know George Soros's theory of reflexivity. The M2 and Bitcoin correlation was more than just data. It was a powerful belief held by market participants. The belief that if M2 goes up, Bitcoin goes up led to preemptive buying. And this buying pushed up the price, which in turn reinforced the belief. It became a self-fulfilling prophecy. But this kind of narrative inevitably creates a crowded trade. The TGA's liquidity drain was the sharp needle that popped this tightly stretched balloon of belief. More than the size of the liquidity drain itself, it was the collapse of the narrative, the realization that the M2 formula is broken, that caused the greater psychological shock. And as the positions built on that belief unwound, it triggered a cascade of panic selling. So, is the M2 model completely finished? There are 3 paths forward. The first scenario is that this was just a temporary disruption. The TGA rebuild was just a short-term, technical issue. Once the Treasury hits its target balance, the liquidity drain stops. In fact, when the government starts spending that money through fiscal outlays, the TGA will flip and become a source of liquidity. In this case, Bitcoin will resynchronize with the massive underlying trend of global M2 growth. This would mean the everything code is still valid. The second scenario is that the M2 model wasn't broken, it was just incomplete. This TGA episode has shown us that the Bitcoin market has become too complex to be explained by a single variable. We must now accept a multi-factor model. This includes not only global M2 liquidity, but also changes in the TGA balance, structural inflows from spot ETFs, supply shocks from the halving, and the regulatory environment in various countries. All of these variables have become part of a new equation that determines the price of Bitcoin. Here is today's conclusion. The M2 model is not dead. However, we have learned an expensive lesson. A technical plumbing issue in the monetary system can shake the entire market. M2 is still the massive tide that determines the long-term direction of Bitcoin. But within that tide, there are powerful waves and whirlpools that can temporarily change the current and sink your boat. That is the TGA, and that is the flow of spot ETF funds. From now on, a sophisticated investor must read both the tide and the waves. The era of relying on one old formula is over.